Hello everyone, welcome back. My name is Arias, and today we're going to be talking about how Invitae will make it to profitability and what's going to need to happen to get them there. This is the core issue surrounding the stock, and I think I may be able to provide some clarity about what is needed to get there. We'll also talk about some of the recent news around Invitae and their Q1 results. Don't forget to like and subscribe if you enjoy this type of content, and leave any video suggestions and feedback in the comments below. And without further ado, let's get into it. First, let's jump to their Q1 2022 results. Revenue is up just 20% year over year to $123 million, which in and of itself is pretty disappointing. However, their exit trajectory was tracking to their annual guidance of 40% in 2022, which is what I needed to hear, as that represents decent growth on this larger base. They ended the quarter with cash and equivalents of $885 million after a burn of $169 million in Q1. This was a marked reduction over Q4, especially with how slow revenue growth was. They reiterated their guide for cash burn of $600 to $650 million in 2022, which would imply a quarterly rate of $150 to $162.5 million per quarter. Burn of $169 million plus puts them a bit behind for Q1, but I'd say they have a good chance of hitting the low end of the guidance as their revenue ramps up and their cost-cutting measures start to hit the bottom line. Hitting the low end of the guidance, as we'll discuss later, gives them at least its shot at making it to profitability, but stick around for more details later in the video. They dropped their capital used in M&A to zero for the quarter to minimize burn, which is a significant change for them, as M&A has been a big source of growth for them in the past. They also reiterated that they're still aiming for non-GAAP gross margin run rate of 45% plus by the end of the quarter, which is another key metric in determining their short-term viability. Before we move on to my takeaways from the conference call, I thought this was a particularly important slide from their deck talking about their product pipeline and their four main verticals. While I won't go through every product, as that could be a whole video in and of itself, I will point out how many new products they are putting out despite the drastic cost-cutting initiatives. While it's definitely the case that most of these were developed when cash burn wasn't as much of an issue and are now just getting to market, I think it shows some resourcefulness that they've been able to maintain their launch cadence despite the focus on burn reduction. Now let's talk about some of my takeaways from the Q1 conference call. My first thought was that management seemed to understand the severity of their current financial position. They also seemed pretty confident that they could manage it. They said they had a plan to hold operating expenses level throughout the rest of the year, which will be instrumental for lowering their cash burn. Another interesting note was they said they expect to exit the year with an $800 million a year revenue run rate. If they are to achieve this, they will need sequential revenue growth over the next few quarters of 15 to 20%, which would represent significant growth and I think emphasizes their confidence in their new product lineup. They continue to repeat the line with reference to how much cash they have as getting us to the end of 2023 or beyond. Later on in the video, we'll take a look at how realistic this actually is. They also said that they are focused on investment in products which would drive near-term margin expansion, as those products would be accretive to the bottom line. They said they'd only consider M&A if the deal was going to be accretive to their margins and cash flows, a drastic departure from their prior M&A activity, which had typically been in new tech to start a new vertical or expand a current one in a specific direction. They also admitted that Q1 was softer than they expected, which could be an ominous sign, as it could be setting up Q2 to disappoint, but we'll have to see for that. Another note was that an analyst asked what they were planning to do about the 2024 converts, which is one of the most concerning issues. Unfortunately, they just gave the generic, "We are evaluating many options, and we'll deal with it when we deem it most appropriate." I really would have liked to hear a more concrete plan there, or at least a goal of when to deal with this issue by. That would have been very helpful. Finally, they stated their collaboration to build a next-gen high-throughput long-read sequencer with PacBio will continue as planned, calling it absolutely essential to their long-term. Moving on to the William Blair conference, which Invitae CEO Sean George presented at. I'll have a link to the full presentation along with all the other resources used in making this video in the description below as usual. Most of the presentation were the typical things that we already know, but there were two intriguing points that will absolutely key for Invitae going forward. The first was around the long-term impact of their genetic data as a service business. He reiterated that as this business develops, more and more revenue will come from this portion. This will be based on having both a large pool of genetic data and the ability for them to work with patients to collect more information about the genetic data to make it more useful. The biggest key is that having a huge pool of genetic information with the metadata surrounding it will make this huge pool of information more valuable because this data may help researchers learn more about genetics, and specifically about the genetics of those who have the data in the pool. This could be seen as a flywheel of sorts, as the more genetic data Invitae collects, the more they can learn from it, and thus the more useful it is. The more useful it is, the more people will want to get their own tests done and contribute to the pool and so on. The other interesting point made was that they have more flexibility than most drug companies to reduce the burn, as they aren't running any long-term trials that will force them to spend long into the future. I'd love to see another 15 to 20 million quarterly burn reduction from Q1 to Q2, as we saw from Q4 to Q1. That would put them on a quarterly pace for $600 million in yearly burn, with room for improvement as we keep going into the year to get them under the $600 million guidance. A final quick point was that while companies will be competing to get into the genetic oncology space, Sean thinks that Invitae will gain their advantage from their existing relationships and their full suite of products. Next up, let's talk about a recent press release put out by Invitae announcing the release of their pharmacogenomics panel and accompanying decision support tool. Let's start by defining pharmacogenomics, which, according to Google, is a field of precision medicine which aims to tailor medical treatment to each person or group of people by looking at how your DNA affects the way you respond to drugs. This is a very prevalent problem, as 1 in 4 patients are prescribed medications that create an atypical response that may be predicted by their genetics. Clearly, there is a need to characterize this response, and this is what Invitae intends to do with this panel. It includes 38 genes, covering the genes of variants associated with 98% of the medicines that, according to the CPIC and FDA, can lead to an actionable major or moderate drug-gene interaction. Successful use of the PGX test would potentially reduce adverse drug effects, including side effects and treatment failures, save time, reduce costs, and improve patient care. This test also includes UScript, which delivers real-time evidence-based guidance from the results of the tests and aids providers in mitigating the risk of potential drug-gene and drug-drug-gene interactions. A recent study showed that PGX and UScript combined reduced rehospitalizations and emergency department visits by 52% and 42% respectively, saving an estimated $4,382 per patient in 60 days. This is an area that can have a huge impact and seems to me to be a no-brainer, as your genetics clearly will have an effect on the way drugs impact you. Oftentimes, there are many potential side effects listed for a drug, many of which the person taking the treatment will never experience. But of course, it would be extremely useful to know with a high degree of certainty what side effects every individual would have. Then, what specific drug taken and dose could be tailored to each patient, and the effects could be known ahead of time. And in a potential end state, each person could have the drug formulation tailored for them. But that's still quite a ways off with our current understanding of genetics. I'm really excited to see the adoption of this panel, not only for Invitae's business, of course, but for the potential positive effects it could have on society. Real quick on this slide, we'll talk about 2 things. First, some positive study results. The full press release will be linked below, but to make a long story short, Invitae has found that genetic testing will be beneficial for skin cancers like melanoma, prostate cancer, and colorectal cancer. This is probably not a surprise, though, to those who are paying attention. Of course, your genes have an effect on the development of these cancers. I'd expect Invitae to be well on their way to releasing panels for early detection and risk profiling of these if they have not already. I think it's also possible that the completion of these studies, some of which were the largest of their kind, could have a positive impact on losses, but if so, it's probably already in the guide. They also put out a press release calling out the requirements for breast cancer testing in Australia, saying 2 out of every 3 with high risk don't qualify for the tests, and those that do face a year or more in wait times for results. This is obviously a problem that Invitae could be instrumental in solving with their ability to scale, driving down costs and wait times, and increasing supply. Finally, in the press release, they supported a newly launched advocacy group campaigning to improve the situation in Australia. While Australia may not be the biggest market for Invitae, they have a chance to fill a significant need here if they can increase the adoption of these tests. Now let's move on to the crux of this video, and really the core issue in the battle swirling around Invitae stock. Will they make it to profitability, and if so, how will they do it? We'll start with their current position. As of the end of Q1 back in March, they had $875 million in cash equivalents, and marketable securities. They also had over $1.5 billion in debt and convertible notes. On its face, that sounds terrible, with approximately 2x the amount of debt and cash and equivalents. But now, let's break down the structure of that debt, which makes it a bit better. They took out about $100 million in debt in association with the closing of the ArcherDX deal, which will be due in 2024. This debt is a variable interest based, but will be at least 10.75%. This could end up being higher than 10.75%, but I don't see it going meaningfully higher, especially because the base rate is set based off a London bank and debt tends to be cheaper across the Atlantic. This results in interest payments of $11 million per year or more, and roughly works out to every 1% increase in the interest rate, Invitae will owe $1 million more per year. The second batch of debt is $350 million in convertible notes, also due in 2024. They are paying a 2% interest rate, or about $7 million per year, and the debt converts price is about $30 per share. Of course, while I'd love for Invitae to do a 10x in the next 2 years and have this debt convert into shares, It doesn't seem very likely, and so they'll probably need to find a way to refinance it and push this obligation down the road. Somewhat ironically, this obligation is partially at fault to their share price being so punished, and thus, as they would make it clear how they will deal with this obligation, that would be a massive catalyst for the stock, getting the shares closer to the conversion price, where these converts become a non-factor. The final big debt obligation is due in 2028 and is $1.15 billion in convertible notes. These notes are at a very reasonable interest rate of 1.5%, costing Invitae $17 million per year, and will convert at $43 a share. Because these aren't due for another 6 years, there's a much higher chance these get converted, in my opinion. But since the obligation is so far out into the future, any predictions are fairly worthless. But the way I see it, if Invitae is going to go belly up, they will do it well before these are due. First, they don't have any big payments due until 2024, which gives them 2 years to prove they can generate reliable cash flows, which is what's important to determine if it's safe to give Invitae more debt. They guided for cash burn of $600 to $650 million in 2022, and if they have a similar $200 million reduction from 2023 to 2022 as they did from last year to this, that would put them burning $400 million in 2023. And I think that holds consistent with their guidance of having enough cash to get them to the end of 2023 and beyond. However, from what I understand, one of my favorite analysts on Twitter, Mayor, who covers and owns Invitae stock, thinks they could burn just $300 million or so in 2023, which would be a 50% reduction from 2022, and I think this is definitely reasonable. That would put them in a very strong position to refinance their debt, as they would be showing progress towards profitability. On the next slide, we'll talk about the options for how Invitae could refinance their debt obligations, and then how we're going to break down some scenarios for margins and revenue growth that get them profitable. Now, what are Invitae's options to pay for their debt obligation in 2024? In my mind, there are 3 ways. First is to cut expenses so drastically that they become free cash flow positive sooner than 2024. This expense cutting portion is already underway. However, their operating expenses are much too high for this to be a realistic solution. Cutting expenses is certainly part of the equation, however, that they have already been pursuing. Like I mentioned earlier, significantly lower expenses leading to less negative cash flows will be required to convince investors to support either of these next 2 options. Invitae's second option is to raise cash by selling shares to investors, thereby diluting the current investors. While this may have been a fine way of raising money back in 2021 with a share price of 50 plus and a market cap above $10 billion, this is not currently the case with a pettily $3 share price and a $600 million market cap. We'll talk more on the next slide about exactly how much they need to raise to get through it, but it will be at least another $450 million to pay off the debt that's about to come due. At a $10 billion market cap, that's just 4% dilution, but at $600 million, that's 75%. And that's assuming they could sell all of their shares at $600 million, which of course all of the dilution would have a massively negative impact on the share price. While they did put up an off-the-shelf offering early in the year, which they could theoretically tap at any time, I would expect them to keep this as a last resort, as dilution would be too great at this low of a valuation. Their third option in my mind, and let me know if there's any other ways you think they will use to get through this, is by raising more debt to pay off the old at a much higher interest rate and by pushing the due date out. I think this has to be the answer. I think they will find a way to refinance the debt at a higher interest rate and a much lower share conversion price as long as they can show a clear path to profitability in late 2023. As long as they can do this, Invitae will be fine. I think they conservatively need about $650 million more to get to profitability, which assumes they bring down their cash burn by $200 million a year from 22 to 23, 23 to 24, and 24 to 25, burning $400 million in 2023, $200 million in 2024, and breaking even in 2025. If we take the midpoint of the cash burn guidance this year, that would give them $430 million at year's end left in cash, which will be burnt in 2023, which would leave them $200 million to pay for operations in 2024, in addition to what's needed to pay off the debt. Anything more will be a good little buffer. I think this is a relatively reasonable task for Invitae, especially if they can significantly decrease the amount of cash they're burning in 2023, and I'm excited to see it play out in real time over the next few quarters and years. Before we get to my conclusions, let's dive a bit deeper on what exactly is needed to reduce the cash burn. There are 3 metrics that make this up, those being revenue, gross margin, and operating expenses. On the call, Invitae gave some important indicators for each of these. They said that they were targeting an $800 million revenue run rate by the end of this year, or $200 million a quarter. That would already be 60% growth in Q1 of 2023 over Q1 of this year if they were just to hold that run rate steady throughout the quarter without any further growth. That's pretty substantial to say the least. They also said that they are targeting a 45% non-GAAP gross margin at the end of this year. At those 2 run rates, that would imply $90 million in gross profit per quarter, meaning that they could afford the same amount in operating expenses per quarter and still break even. They also said that expenses should be flat for the rest of the year from Q1. Now, expenses were still off the charts high compared to our $90 million in quarterly allowance of gross profit to break even, as they had over $200 million in non-GAAP operating expenses in Q1. Now let's look forward a bit at a few potential scenarios that could allow them to make it to profitability. First, this is purely just a thought experiment, as OPEX will not be flat, nor should margins be flat either. But if they were to make it flat at about $200 million a quarter and 45% gross margins, revenue of $1.78 billion would break even. That would require 41% revenue growth, which is about their current pace, for 3 years to break even in 2025, or 67% to break even in 2024, which is a bit too high even for a bull like me to envision. Now, what would be more realistic? If they had revenue accelerate to an average of 45% growth year over year for the next 3 years until 2025, and if gross margins got to 55% in that year, and if they could keep operating expense growth to under 7.5% over the same period, Invitae would end up $30 million profitable in 2025. They would then be self-funding and could shift back their focus towards growth while staying profitable to maximize their long-term value. Even with this profitability, they would still need money to get through 2024 and to roll over the debt that comes due around that time. As I have said, it will need to be clear to investors that Invitae has a clear path to profitability for them to do this. And if they can hit these metrics, I think that investors should be able to discern from these metrics if they're on that path. If we get super aggressive, what will we need for profitability in 2024? One scenario is 60% revenue growth, 55% gross margins, and 2.5% or less yearly operating expenses growth over the ensuing 2 years, which would leave us with less than $10 million profit in 2024. The revenue growth required to hit these metrics would be off the charts and is very unlikely in my opinion, but not impossible. I think 2024 profitability would paint a very clear picture for investors that Invitae is going to be solvent long term and is worth the short-term risk. Finally, looking forward about 7 or 8 months or so to the release of the Q4 2022 earnings and guidance for the full year 2023, I would like to see a gross margin guide to stay above 45% and would be very happy to see them guide to be above 50%. I would like to see revenue growth guide to be north of 40% year over year and operating expenses to tick up less than 10% year over year. While I think the gross margins and operating expenses targets are very doable, I'll be laser focused on the revenue growth to see if they can come in with a 40% plus number despite the relatively lower level of spending on bringing new products to market. Beyond the numbers, investors will of course also want to see that Invitae is in a strong business position with no ominous looming competitive threats on the horizon to deem them worthy of investment. Finally, for my conclusions. There is definitely a load of risk that you'll be taking on by adding Invitae to your portfolio. However, I really don't think management, particularly Sean George, is going to let this company die. They have put too much into it for them to let it just go under. One risk we have not talked about much is a buyout for a low price. While it is another risk, I think the market dynamics are such that it will be unlikely until late 2023 or early 2024, but it's something we'll have to watch out for. In the meantime, it's important to stay focused on their new products entering the market and how they're performing, as well as their 3 key metrics of revenue growth, gross margin, and operating expenses. If they do indeed make it, the stock should fly. As for what I am doing, while I'm down huge, I'm still buying, but I've again run out of money. I have grown my position over tenfold since the start of the crash, and I've gotten my cost basis down to $10.81. This means I'm still down over 76% overall on my current position. Invitae makes up about 4.25% of my portfolio and about 18% of my portfolio ex-Tesla. I will continue to add, especially in times with a few dark red days in a row. Thanks for watching. What do you think of Invitae and their cash position? Will they make it? Why or why not? Let me know in the comments below. Thanks again for watching and have a great rest of your day.